Most people think building wealth requires constant attention, perfect timing, and insider knowledge. They spend hours watching financial news, tracking market movements, and second-guessing every decision. Meanwhile, a group of regular investors using a strategy created by Vanguard founder John Bogle consistently outperform 80% of active traders while spending less than 1 hour per year managing their portfolios. The difference is not intelligence or luck. The difference is understanding that complexity is the enemy of wealth building. Here at KB Blue Tree, we focus on strategies that work for people with full lives outside of finance. The investment industry profits from confusion. They want you to believe investing is complicated, so you pay for their advice, trade frequently to generate commissions, and buy expensive actively managed funds. The truth is simpler and more profitable. Buy low-cost index funds, invest consistently regardless of market conditions, and leave it alone for decades. This boring approach built more millionaires than any day trading course or stock-picking newsletter ever will. Problem: you start investing with good intentions. You open a brokerage account, deposit some money, and immediately feel overwhelmed by choices. Thousands of stocks, hundreds of funds, conflicting advice everywhere you look. So you do what seems logical. You research actively managed funds with impressive past performance. You buy a mix of sector funds trying to predict which industries will boom. You queue cash on the sidelines waiting for the perfect entry point. You are trying to be smart, but you are actually guaranteeing mediocre results. The active management trap costs you more than you realize. That mutual fund with the 1.5% expense ratio does not sound expensive until you understand compound math. Over 30 years, that extra 1.2% in fees compared to a low-cost index fund costs you nearly 30% of your final portfolio value. You're paying tens of thousands of dollars for the privilege of likely underperforming the market. Fund managers market past performance, knowing most investors do not realize that performance rarely persists. Last decade's star fund is this decade's mediocre performer. Market timing destroys more wealth than market crashes. You convince yourself you will invest when conditions look better. The market drops 10% and you wait for it to drop more. It rises 15% and you wait for a pullback. Years pass and you are still waiting for the perfect moment that never arrives. Meanwhile, you missed thousands of dollars in gains. The longer you wait, the more you need to catch up, which makes you take bigger risks or give up entirely. Timing the market is impossible, but time in the market is everything. Emotional decision-making turns investing into a losing game. Markets drop 20% and fear takes over. You sell everything to stop the bleeding, locking in losses. Markets recover and you are on the sidelines. You buy back in near the top because you cannot stand missing out. Then the next correction happens and the cycle repeats. You consistently buy high and sell low because your emotions override rational decision-making. You are not investing. You are reacting, and reactions are expensive. The complexity itself becomes the problem. You own 15 different funds trying to cover every possible scenario. Technology funds, small cap value, emerging markets, real estate, commodities. You spend hours rebalancing, researching replacements for underperforming funds, and reading analysis that contradicts itself. Your portfolio is not optimized. It is complicated, overlapping, and impossible to manage effectively. Complexity makes you feel sophisticated while guaranteeing underperformance and anxiety. Solutions. The Boglehead strategy eliminates every problem that plagues active investors through radical simplicity. The entire approach fits on an index card. Buy total market index funds with the lowest expense ratios available. Invest a fixed amount every month regardless of market conditions. Never try to time markets or pick winning sectors, rebalance once per year. That is it. No stock picking, no market timing, no chasing performance, no stress. This simplicity is not lazy, it is strategic. Start with a 3-fund portfolio that covers global diversification with minimum overlap. Fund 1 is a total U.S. stock market index fund giving you ownership in thousands of American companies. Fund 2 is a total international stock market index fund providing exposure to developed and emerging markets worldwide. Fund 3 is a total bond market index fund offering stability and income. These 3 funds give you complete market exposure across asset classes and geographies. Everything else is unnecessary complication. Your asset allocation depends on your timeline, not market predictions. If you are 30 years old, with decades until retirement, you might hold 80% stocks and 20% bonds split between domestic and international equities. At 50, you might shift to 60% stocks and 40% bonds as you approach retirement. The key is setting your allocation based on when you need the money, not what you think markets will do. Your allocation changes with your life stage, not with market conditions. Automatic investing removes emotion from the equation entirely. Set up automatic monthly transfers from your checking account to your investment account. Set up automatic purchases of your 3 funds according to your target allocation. Every month, money leaves your account and buys more index funds, whether markets are up, down, or sideways. You never have to decide if now is a good time to invest. The decision is already made. This automation ensures you buy more shares when prices are low and fewer when prices are high, which is exactly what you want. Dollar cost averaging through automatic investing turns volatility into your advantage. When markets drop 15%, your automatic investment buys 15% more shares for the same dollar amount. When markets rise, you benefit from the shares you already own, increasing in value. You win either way because you are consistently buying regardless of price. This removes the pressure of perfect timing and ensures you participate in every market recovery. Rebalancing once per year maintains your target allocation without constant tinkering. If your target is 70% stocks and 30% bonds, a strong stock market year might push you to 75% stocks and 25% bonds. Once per year, you sell enough stocks and buy enough bonds to return to your 70/30ths target. This forces you to sell high and buy low systematically. Set a calendar reminder for the same date every year. Check your allocation, make adjustments if needed, and forget about it for another 12 months. Tax-advantaged accounts supercharge this strategy. Max out your 401k contributions first, especially if your employer matches. That matches free money that instantly boosts your returns. Next, fund a Roth IRA up to the annual limit. The tax-free growth in retirement is invaluable. Only after maxing these accounts should you invest in taxable brokerage accounts. The tax savings over decades add tens of thousands of dollars to your final wealth without any additional risk or effort. Solutions. The real power comes from doing nothing. When markets crash, you do nothing except continue your automatic investments. When markets boom, you do nothing except continue your automatic investments. When financial news screams about crises or opportunities, you do nothing. This discipline to do nothing is harder than it sounds because humans crave action, but the data is clear. Investors who trade less outperform investors who trade more. The best investment decision is often the decision not to make any changes. Cost matters more than most investors understand. A fund charging 0.03% per year versus one charging 1.00% makes an enormous difference over time. On a $100,000 portfolio growing at 8% annually, the low-cost fund saves you over $180,000 in fees over 30 years. That is not a typo. Fees compound against you just like returns compound for you. Choosing the lowest cost index funds available is one of the highest return decisions you will ever make. Success story. Savannah started investing at 28 with $12,000 saved and no investing knowledge. She discovered the Bogleheads philosophy and set up a simple 3-fund portfolio through Vanguard. Total U.S. Stock Market Fund, Total International Stock Market Fund, and Total Bond Market Fund split 60/30ths, 10 based on her age and timeline. She automated $800 monthly investments split across these 3 funds and committed to not checking her account more than once per quarter. The first year tested her resolve. Markets dropped 18% 6 months after she started investing. Her coworkers panicked and sold their holdings. Financial news predicted worse crashes ahead. Savannah did nothing except watch her automatic $800 monthly investment buy more shares at lower prices. She felt scared, but trusted the strategy. By year-end, markets recovered and her consistent buying during the dip positioned her perfectly for the rebound. She learned that doing nothing during volatility is actually doing something powerful. Over the next 12 years, Savannah never changed her strategy. She increased her monthly contribution to $1,200 after promotions, but kept the same 3-fund allocation. She rebalanced once per year on her birthday, and otherwise ignored her portfolio completely. If you want to know how Savannah implemented her investing strategy using AI as her advantage, check out this video, the Augmentation Masterclass. Human plus AI equals career advantage, now available on Gumroad and PayHip. Check links in the description box. She never tried to time the market, never chased hot sectors, never panicked during corrections. She lived her life while her portfolio grew automatically in the background. The simplicity freed her to focus on career advancement and building a consulting side business. At 40 years old, Savannah's portfolio reached $387,000. Through consistent contributions and market returns, her investment returns averaged 9.2% annually, outperforming 78% of actively managed funds in her category. She spent a total of maybe 12 hours over 12 years managing her investments, less than 5 minutes per month. Her coworkers, who constantly traded, researched individual stocks, and tried to time markets, averaged returns 3 to 4% lower, while spending hundreds of hours on portfolio management. Savannah's boring strategy beat their exciting one by every measure that matters. Call to action. Open your current brokerage account and count how many different investments you own. If the number is higher than 5, you are overcomplicating your portfolio. Simplification is not dumbing down, it is optimization. The Boglehead strategy proves that the simplest approach consistently beats complex ones over time horizons that matter. You do not need 20 funds to be diversified. You need 3 good ones and the discipline to leave them alone. Set up your 3-fund portfolio this week. Choose a total U.S. stock market index fund, a total international stock market index fund, and a total bond market index fund from providers like Vanguard, Fidelity, or Schwab. Make sure the expense ratios are below 0.10%. Side your allocation based on your age and risk tolerance, not market predictions. Set up automatic monthly investments that fit your budget. Start with whatever amount you can sustain, even if that is only $100 monthly. Consistency matters more than size. If you are interested in learning how to scale your solopreneur business, check out this video, The Digital Freedom Blueprint. Scale your solo business to $10,000 a month. Now available on Gumroad and PayHip. Check links in the description. Make a commitment to yourself right now. Will not check your portfolio more than once per quarter. Will not sell during market downturns. Will not chase performance or buy hot sectors. Will rebalance once per year on a specific date and otherwise do nothing. Write this commitment down. The hardest part of the Boglehead strategy is not the implementation. It is resisting the urge to do something when doing nothing is optimal. Subscribe to KB Bluetree for more wealth-building strategies that prioritize your time and peace of mind over complexity. If you want to learn what to do with the time you save by not obsessing over investments, check out KB Bluetree Productivity and Career Development for strategies to accelerate your income and career growth. Like this video if you are ready to embrace boring investing that actually builds wealth. The financial industry wants you to believe investing is complicated because complexity generates fees. The truth is that simple strategies executed with discipline create more wealth than complex strategies executed with emotion. Your choice is clear. Complicate your portfolio and stress your life, or simplify your approach and build lasting wealth. Start today.